Hi, everybody, and welcome. I'm Bonnie Halper, and this is our online investor insights. And today our guests are Joe Milam of AngelSpan and Glenn Argenbright of Quake Capital. I'm Bonnie. I help. What I do is I help founders with their talking points and strategies, and oops,
Pitch
and
decks.
pitch decks and help them and introduce them to investors and strategic partners where and when uh, appropriate. In fact, I just did one recently. Very, very happy about that. You'll be hearing about them soon. First, and I'll put and I write a weekly newsletter covering tech, and I'll put the link in the chat. And first, I want to thank Joseph for hosting us.
No
Joseph
problem.
Katz, tell us about you and what you do.
Hey, Bonnie, good to be here as always with everyone. Always fun to have Joe and Glenn on a call. I'll keep it short because I think most of the people in the room know each other.
Yeah.
Joseph Katz, I help startups with marketing, growing their business. So anything to take them to market. So I'll hand it off. I'll put my contact in the chat and everyone should
Yes.
have a great call.
As will I. So, Joe and Glenn, do you want to introduce yourselves, or should we go straight to Eric's question?
Oh, Eric's question. Shit, everybody knows each other.
Yeah, I know. But Eric, you can briefly introduce yourself if you'd like to.
Yeah, Eric Becker. I'm the founder and CEO of Milam. And I have a question that kind of dovetails on something that you were just mentioning, Glenn, but it's only something that I think you and Joe can answer. Is something top of mind is what's a category you believe will look obvious in hindsight, but most investors right now think it's too early or not venture scalable. You were talking about being on the forefront of things, and I'm just with everything being AI, there has to be something out there that people are overlooking right now. With your exposure, I was just curious if you had any thoughts on that.
Sure. Joe, you want me to go? You want to go? What do you want?
I can be really quick. In my prior career, I managed money, and we didn't try and predict the future. We managed the present very effectively. So I look at the venture asset classes as that's even more imperative. So to try and predict the future with innovation is really, really, really hard. So I don't even try. So I don't have an opinion at all to answer your question. It's easy to spot what's wrong with AI, as Glenn laid out before we started recording. I mean, it's those things are easy to understand how that's going to end. But to say what's going to fill the vacuum or what's going to be hot, I got nothing. Glenn?
Yeah, I knew you'd have a good answer there, Joe. And just in terms of the general, I think from our perspective, we tend to try and avoid trend investment. And I've historically, Eric, tried to avoid trend. I just said a minute ago that I'm pretty good at spotting where the industry's going, but that's not the same. I don't tend to look for the next hot thing. I try and look for the sustainable, and I mean it in not the popular way of the last 5, 6 years. I mean like the business that'll last. So when I tend to look at a market, and that's one of the problems I have with AI. When I look at a market, I look for a footprint within the market that can generate enough capital to sustain itself, create a flywheel effectively. I need that within, opportunity within that industry. So business that can do the same. And I need buyers. And there's two types, obviously, the consumer, but I need buyers of the business because my odds of going public are insanely thin. So every deal I've ever done, I already knew the exit. It's one of the challenges I have with most modern founders. And I say this with all respect to anybody who's on or listening. I think one of the challenges now is access to capital is so much easier. It may not feel that way for founders, but I can tell you with certainty, it's a lot easier to get capital today than it was 30 years ago. Like we didn't even know who the hell to call. Like there was no so if you didn't come from a wealthy family, or if you didn't come out of your dad didn't found Fairchild Computer or something, you didn't have the ability to go raise money because you didn't have a phone book of who to call. In Sand Hill Road, didn't exist in the, Joe was back there, but there wasn't the same as it is now. So the
Right.
access to capital has changed, I think, in many ways, the ways that a founder approaches a business. We had to think about two things very militantly 30 years ago. We had to think about how the hell are we going to make revenue quickly and get to
Mhm.
cash flow break even. And then we had to think about how we were going to exit the company at some point. Like, how are we going to get out? And we had to build a strategy for that almost from day one because you're building a budget to something. It's a bridge to something, right? And I think now it's just a series of of never-ending rounds is what we see a lot. And a lot of times the founders can give me the jazz hands of what an exit might look like. I was, you guys have heard me talk before about the person playing the CEO in the high school play, the founder. But I don't honestly think many founders spend a lot of time thinking about the exit. So to go back to your question, it's not entirely dissimilar to Joe. I don't pick necessarily the hot next thing. I look for a sustainable industry with a lot of buyers where you can make cash with, you can sell, you can actually sell at a reasonable margin. For me right now, a lot of what we've been pouring money into, and this isn't really much of a shift for us. For the last 5 years, we've been pouring into infrastructure. And by the way, if I was betting on a space, I'd be betting on power. I told people this 2 years ago. Um,
Yeah,
and
it's
for
the
the reasons
hottest.
I just mentioned, right? I looked at forming a power fund a little over 2 years ago because I saw this huge disconnect with AI. And it's not it's not green energy or any it's all energy. We need efficiency, we need the ability to track, we need the ability to store, we need the ability to create. Like there are so many
Distribute.
opportunities in
Yeah.
distribute, transmission. There's so many opportunities in power and energy right now that if I was picking an industry, that's where I'd pick. But
I just read that it's the hottest vertical right now.
I would have been there 2 years ago. So I just made a decision to be blunt. I decided I didn't want to run a fund for another 10 years. That's all it came down to. I'm handing off, you kind of know the story there, Eric. I'm handing off to my partner Jason, and he's going to go the direction he wants to go. But if I was running a fund for another 10 years, that's the area I would have played in 2 years ago. The other things I think that are hot, I mentioned infrastructure, so that's certainly one leg. I would look at transportation, logistics, manufacturing, obviously robotics. Um, and why? Because look, if I don't think that AI is going away. I think that there's going to be a whole crap ton of failure, and I don't necessarily want to make those bets right now. But as an industry, I think that there's going to be, or as a technology rather, I think there's going to be huge impact and opportunity there. And it's going to massively impact transportation and logistics. It's going to supply chain and robotics and, manufacturing and aviation and every other damn thing you can think of. So I, and that's in, and I'm obviously putting bets, and Bonnie and Joe know this. I've been putting bets in aerospace lately because I think that's a really interesting space area also. So I would say hardcore infrastructure leaning businesses is and efficiency and innovation, higher margin creation. Those are the things I'm keyed on.
Speaking of endless rounds, I just not too long ago, and I know that they're going public soon. Databricks raised their ready for this Series L. I didn't even know that there was a Series L. Series L.
It's
And where does that leave the early investors? Is my question.
Oh yeah.
not where they wanted to be.
Exactly.
Yeah, Ian's got a question, and I want to come back to Databricks and that topic. Not Databricks in
Yeah,
particular, but adjacent topic.
Thank
yeah.
you,
Okay,
Glenn.
quick. So, Glenn, you mentioned the capital is a lot more available now than it had been in the past. And it struck me that a key difference between the dot-com boom and the current situation is it seems like a very large percentage of the capital is coming from outside the US, and in particular from the Gulf. And yet there doesn't seem to be a clear awareness of this among many founders and other people that you talk to who should have a clear view of what's going on. Well, what do you think about that?
Well, first, it's hard as hell to get that money. You got to be a household name. So we have kind of three buckets. No, there's more, but I'm just going to focus on three buckets of company types. All right. I'm just going to say everything other than a startup. Then you've got startups. And then there's this thing in the middle, which are these celebrity startups. These startups that are brand names that everybody knows. They're not it. I wouldn't really, I don't think they're really startups per se. Those are the only ones that can get money generally. I hate absolutes, but when you look at, the sovereign wealth funds and, money coming out of the Middle East, you look at money coming out of China, it's almost entirely going into these celebrity deals. And that's maybe the wrong way to put it, but these highly branded, well-known, one of the things you do when you run a fund like I do, and I think again, Bonnie and Joe know this, I field calls from secondary funds all the time. And the secondary fund is looking to buy portions of your portfolio or positions that are held by other investors in your fund that were bought maybe 4 or 5 years ago. They haven't exited yet, so they haven't made all their money, but they can buy them at a discount to that future value with less risk. Well, one of the things you learn, those secondary funds, the reason I bring it up is they're really similar to the outside the US capital, the big pockets. Okay. They want, do you have Anthropic? Do you have the next, open, like basically they want, or the next Uber, like that's probably a better example. They want to know, do you have some big name brand that just hasn't happened to go public yet? And that's what you're going to get typically when you look at a lot of the outside US capital. I'm not trying to dump on it. I think you're right. A lot of founders don't know, and there are ways that you can get to it. But I'm just telling you two problems. One, they are looking for those high profile deals. The other, probably bigger problem for everybody on this call is their ticket size is so ridiculously huge. So that deal I just mentioned, AMI, which is not even a company really, it's a name with a guy coming out of Meta, and he's raising almost 600 million. He'll go get money from them because they can write him a $30 million check. But you don't want you couldn't take a $30 million check. So that's going to be very difficult to do. So I struggle. I introduce, typically what I'll do there, Ian, is with our founders, I'll introduce them to European high net worths, family offices, and funds. We certainly have done some of that with the Middle East. We've got good relationships there. One of our partners is actually in Dubai. But we just know that that's a tough road. That's a really difficult deal until you get to the A or the B. And even the A is honestly too small for most of you.
Yeah. It's been pointed out that a very high percentage of the capital being invested is going to the Magnificent Seven.
Yeah.
Right now, like disproportionately large.
Yeah.
Which seems to raise a lot of concerns.
In fact,
It should.
Yeah. Andreessen Horowitz's last round, most of it came from sovereign wealth from the Middle East.
Right.
They didn't really go very public with that, but that's where it came from.
Yeah, and when you get to that and you look at those big funds that are deploying capital, they're not deploying capital even when they say they do. See, I've seen on occasion, and I'm not going to name any names because I don't want to piss anybody off, which I sometimes am okay doing, but I'd rather not on this one. When they say they do seed, their definition of seed is utterly different than my definition of seed. Their definition of seed may as well be late A, which is.
I work with those funds that say they do seed, they do early stage, but they want to see revenue of at least $1 million.
Yeah,
that's not seed.
At least. I mean, you and I were talking, like, I don't know, a couple of weeks ago, Bonnie, about a particular fund and somebody we know at that particular fund, and it's a great fund, and I love them to pieces, and I really like the manager, but he started talking about seed, and I was just looking at, you're talking about a company that it's like you're you're talking about somebody in a master's program. You forgot about every elementary school, grade school, high school, college. Like their definition of seed is certainly higher than $1 million. They were talking more like 5 million. And I'm like, that's for us, that's a company that has been in our portfolio for 2 years, maybe 2.5, even 3 years sometimes. So that's we certainly have some that are in the hundreds of millions, but we have a lot of deals we've had for 3 years that are at that level. And we invested in the seed. So, anyways, I don't know, Ian, I don't know that there's a good, you're right, it's there. I think there's a ton of access. What I would say is that there is a lot more access to international capital than there used to be. It's still very hard to navigate. What's happening a lot of times, and I don't know how far I want to get into this, but what's happening a lot of times, they're trying to move money out of other, particularly China. We saw this going back 5-6 years. There was a heavy move to try and get money out of the country. And so startups are actually a fairly decent way. If you can get money out of the country, it's not a bad way to deploy it. But they still, obviously getting it out is difficult to begin with. But a lot of times it's a diversification strategy in those domains.
Yeah, that's helpful. Thank you. Thank you.
So, Joe, you were going to comment on Databricks Series L. When I saw that, I was like, huh?
No, I was at this event in Austin a couple weeks ago, and I was pleasantly surprised. They call themselves the Legacy Investor Circle, so that was a good reason to attend. And it was family office folks, and for Austin, that's an oxymoron typically because there's not a lot of serious folks in Austin. It's all new money, so and the conversations are oftentimes very superficial. All that being said, I was invited as a guest to this thing, and I was pleasantly surprised with the content and the speaker. And this was a fella's, he's fourth gen, running the family office, and he was speaking about his experiences. His grandfather, great grandfather, started a company that was sold to Pfizer, and they sat on Pfizer stock. They sold it in the 63 to Pfizer. And the family just kept Pfizer stock and lived off the dividends and that sort of stuff. And then he took over, and he's decided to run the family office with entirely a venture strategy. Oddly enough.
Wow.
Yeah. Well, anyway, that's a whole other conversation.
I hope they make it to. I hope they make it to Generation 5.
Yeah. Well, but he talked about secondaries and how they're always being offered secondaries and how he's invested in secondaries. And this was, I didn't know this, and it was fascinating. And I think this is the whole secondaries thing is also not going to end well, or it's going to have its own crash and burn. Not that secondaries are going to go away, but the current iteration of secondaries, I think, fuels some of this bubble behavior that we're hearing about these celebrity companies. In that so much of the secondary activity, apparently, according to him, is founders or employees selling their shares to these people that want into this celebrity company.
Mm-hmm.
Well, those shares are common stock. Oops. When you're talking about Series L, Databricks, though there's so many layers of preferences in those funding rounds at these. That's how they can have these uber valuations. Is they have liquidity preferences that allows them to get a return that ultimately makes the common shares almost worthless. And he had talked about several very large companies that he had secondary interests in. I didn't recognize the names. They weren't the SpaceXs and that sort of stuff, but they were the next tier of, because a lot of other people in the room had heard about them. I hadn't. And they had exits. And he says, we made no money. We barely got our money back because they bought secondary shares from an employee. And with all liquidation preferences, the common stock virtually had nothing. Now, folks, if I don't know if you've seen it, but Goldman Sachs bought into a secondary platform. Schwab bought into bought a secondary platform. Forge, what Goldman bought, Industry Ventures, and then Morgan. Who was it that bought Equity Zen? Was it Morgan Stanley that bought Equity Zen,
I don't know. Yeah, I
which is
didn't
a
keep track.
secondary platform? So again, when Wall Street comes into the space, it's going to get distorted, and it's to bring it to retail, and the retail is going to suck up these common shares on the secondary market, and they're creating liquidity for the employees, and the retail investors are going to be left holding the empty bag. That's a prediction. You want a prediction? That's a prediction. That this whole secondary venture market is going to have a massive black eye within 18 months.
It wasn't JP
And that's
Morgan.
going to constrict.
It
I'm
wasn't
sorry?
JP Morgan, was it? You said Morgan. It wasn't JP Morgan because I recently saw
No, it
something.
wasn't Morgan. It was Morgan Stanley, the brokerage,
Okay.
not the bank. Yeah, Morgan Stanley. Whoever the hell owns Morgan Stanley these days. Or maybe they're still standalone. But yeah, that was really revealing. And when you see when that's the case, and then you see the Wall Street firms buying into these secondary platforms, that's not going to end well. That is
No,
highly
it's just a
predictable
product.
outcomes.
Yeah, it's just a product to take to their dentists and doctors and lawyers to,
Exactly.
just like they did the pre-IPO stuff back in the early 2000s. They would, that was such a
Just thing.
VIP. Yeah.
Oh yeah, it's the same thing, and it blows up. And so,
Yeah.
and to me, again, for what we're trying to do, that's the good news, because that will be yet another representation of Silicon Valley. Well, this is not unlike what happened with the venture industry and Freight Quattrone during the bubble, where fraud entered and shit got
Yeah.
nasty and people went to jail. And when Wall Street gets close to the venture industry, that is a very toxic relationship.
Yeah.
Um,
What would you suggest, Joe, for founders though? Like, okay, that's great. And I think that makes tons of sense. But the challenge I see is if you start having collapse in that area and you bring down the big brands, is there a lever that founders can take advantage of that action as it happens? One of the challenges is capital. It's sort of like a shoreline. The capital recedes a little bit, right? So when you have that, there will be a 6 month, maybe, I don't know how long, but there will be a pullback in capital because everybody's like, oh, you know,
right.
so, I mean, you have to be prepared for that to some degree, that there could be a disruption to capital markets for startups. But I'm just trying to think how a startup might position themselves. I mean, the main thing, I never really focus too much on that stuff. I try and focus on just building the most solid business I can. And as I mentioned earlier, I'm always building to a really clear exit strategy. So I'm more focused on whether the corporate buyers, are going to be like, I don't worry about what's going to happen with Wall Street generally. I don't worry what's going to happen with venture markets generally. I only worry about those things as they may affect the larger buyers in the space. But I don't know if there's anything else you can do to take advantage of that kind of action if you think it's going to happen.
Well, you can't predict it, for one thing. As an entrepreneur, the right course of action as an entrepreneur is to do exactly what you just described. In fact, it's just building a business.
Yeah.
Forget about playing and pandering to the financial source. Build a business. All right. Solve an otherwise unmet need and build a business. Get customers. Blocking and tackling is the answer.
So the two other elements I would say, though, is if we believe that's going to happen, and I think that makes logical sense, get to cash flow break even as fast as you can, or get a little bit of a war chest. You certainly need to have a runway if you think capital is going to pull back at some point.
Well, you said something earlier that's definitely easier to get capital, and from 30 years ago, and you're absolutely right. We don't have the sheer volume of startups. back then that we do today. We didn't have the sheer volume of angel groups back then. The angel groups were virtually non-existent except for a couple, and now they're everywhere. And the businesses were a lot more expensive to build. You had to buy your own servers. You had to build your own server
Yeah.
racks, right? So the business,
$100,000. Yeah. Hmm.
right? So yeah, the industry is vastly different, but it doesn't make it better. The lack of inertia in funding and the lack of heavy capital requirements in the business models isn't necessarily a great thing. It's an iterative evolutionary step to me, to the maturation of this process, of the proper marketplace of entrepreneurs and entrepreneurial capital. Okay. That to me is where we're at, and we are in a transition phase. If we have anything to say about it, on what the vision that we've been pursuing, and I think we're going to have a lot to say here soon with the people coming on board, that we're going to define what's next in access to capital. It's going to look much more like an asset class from a investment approach, and entrepreneurs are going to find the relief that if they can, in fact, you don't have to compete for the cult of personality and celebrity investors on your cap table to get access to capital, nor do you have to chase the shiny object, latest new innovation to catch the FOMO angels and the FOMO early stage venture firms that are throwing money behind.
Yeah, the
passion.
startup world has become a lot like People magazine. It really
Exactly.
has. It's
Yeah.
I hate to say it, but there is a getting on the cover of Us or People or whatever, the Star, I don't know these magazines, but getting on just whatever's at the checkout stand, getting on the cover is, that sort of equivalent in startup world has become a big deal. You mentioned celebrity investors, having Reid Hoffman, having Sergey Brin, having even celebrities, Ashton Kutcher, Will Smith.
Kutcher, absolutely. Yeah. You get these people, and that is just absolutely bullshit.
Yeah.
But it's a commentary on the way the industry has evolved in this phase. And this is what you've seen me writing about. This is limbic capitalism, where that limbic brain stimulus, that dopamine high of FOMO, of cult of personality, that's all limbic driven. And limbic is perpetually shorter and shorter term. And that's where those iterations.
Yeah, let me share a brief comment on something there. And again, I won't name names. I don't want to upset any of our founders for sure, but I can tell you, we've got every name I just mentioned, celebrity wise, is in some of our deals. The best deals we have don't have any of those names. But let me back up a step. When I say the best deals, that's my opinion. Like what I view when I look at a company and look at their prognosis for success, exit, growth, revenues, etc., those companies don't have the big celebrity names, but they also don't have the big ticket checks. So when I look at the companies that have the higher valuations, that have raised more money, there is 100% correlation with those things. And it's frustrating for founders because I'm at the end of the day, I'm pretty confident that I'm going to be right, and that the companies that don't have those names that I think are better are going to have bigger exits, make more money, be more successful. Unfortunately, those founders are they're very frustrated because they know how good they are, and they don't have necessarily the same access to capital that those deals do. So why do I share that? I don't know that there's anything, a learning lesson there, other than to say that it's completely, I would argue, a lottery ticket to get, well, let me say something else. The deals that I know that have those investors are one of two things. Either politically top of mind, so they're riding the wave of whatever the hottest, latest, newest political trend is. And when I say political trend, I mean things like, when green energy was a big push, that would be a good example. You can argue, I don't mean like red, blue team. I just mean political. It's like It transcends just industry. Anytime you see governments enacting policy that impact the outcome, then you know it's political. So political things tend to get those kind of investors. The other thing is hot trends. So AI, would be a good example. One of the deals we have is front and center on that, and was one of the earlier movers. And so they got a lot of that. But other than that, it's a total lottery ticket. You can't, as a founder, go out and expect that you're going to get, Ashton Kutcher, Will Smith, Reid Hoffman. Unless you don't have any way of connecting with those people, and they're not hunting the way that normal funds hunt. So you're not going to, Leonardo DiCaprio has a family office. I doubt many of you are spending time with him. So, I mean, it's just you can't count on that. So all you can really do is build your business as good as you can, to the best of your ability. And I'm telling you right now, I think that those businesses will actually outperform and outlast anyway. So don't be frustrated, but getting to that capital is and I'm not taking anything away from it, and they can be helpful, no question about it, but it's just so difficult for you to navigate to it.
Don't chase it.
Yeah, don't chase it at all.
Mark.
Yeah. So, I guess I got some questions and comments. First question is why do founders want celebrity capital? I mean, what is other than the name, what do celebrities bring to the table? Especially if you're not going to be in a consumer product where maybe having the name, consumers will react to that. When I think of founders, and again, we play in a market, maybe it's different. And I'm an investment banker where we do capital raising and primarily M&A transactions for tech companies. And the reason why most of what we do is M&A transactions is because companies don't think they need a banker or a strong advisor when they're raising capital. And I think that's one of the problems they get themselves into. But the companies we work with, I mean, we've represented companies on all the coast, but we focus more on companies on what we call the middle corridor of the country. And because they're not getting the attention of the bankers on the coast who are working with the Silicon Valley, the big name companies that are going to eventually do IPOs and do series, JKLs. And what we find is if you have and when you talk about building good companies, that's the best thing that's going to raise capital. But for founders who just may not have sophisticated investors, in their capital stack, then, they need help in identifying, and they could be a great company, but what they need are the growth equity investors out there that will write the $30 million checks. They don't need to go to some sovereign fund in the Middle East to get that. But these investors will also provide a lot, in addition to the capital, a broad range of support to help them grow the companies. And you've got a much better relationship. And if you run the process correctly, you're going to get much better terms. Because, when you're doing an M&A transaction, you want to run a competitive process to get the best valuation. When you're doing a capital raise, you certainly want to run a competitive process to get a better valuation, reduce dilution. But you also want to run a competitive process to get better terms and avoid those repressive liquidation preferences, 2 and 3x liquidation preferences. They have no idea what those mean. A lot of founders we find, they accept the terms because the check is big enough, and they don't realize till it's too late when they get to an exit what they gave up at, it could have been 3 to 5 years previously. It's way too late to even try and correct that situation. So that's what we see out there. And it's just, I mean, I love listening to you guys, and I've come to a lot of these. I go to Joe's office hours quite a bit. But we see it, the markets that we play in, and which I'm
you're not
probably
wrong.
90% of the founders out there are not these celebrity founders.
Oh, no, not at all. These are I guess my point on that is that there's a lot of founders that are aspiring to try and get that. because there's a certain sachet that comes with it. Like there's just a certain amount of swagger that you get from that. And I would say, just to your point, the funny thing is Quake, my fund, we hunt basically in off markets. That's our large part of our thesis. We avoid Silicon Valley. We don't do a whole lot in New York City. We try and stay out of Boston. Like we focus on, probably the hottest markets that we would be in would be like Silicon Slopes and Utah. Go
Right.
down into Atlanta, but we generally try and avoid where the valuations are over, extended versus the actual revenues and fundamentals. So I'm with you right there. I think, to your point, the reason why founders want that money, you're talking about smart money, dumb money, right? And so what do these guys? Well, some of them are pretty good. Look, Reid Hoffman brings a lot to the table. I've seen him in deals, and he actually does a lot to help. Ashton Kutcher can actually do a lot. If you do have a commercial product, to your point, they have social media following, so they can have a major impact in a CPG, consumer goods product. They're packaged goods. They're really pretty strong. We've got a fund we work with, which is all NFL players, and they can be very helpful in terms of their social network and access to teams and athletes and leagues and all of that. So they can bring things to the table that you and I probably can't access in certain instances. I don't have millions of followers. I don't have, well, that's not a good example. I know a lot of the team owners, but I don't know a lot of the franchises, the actual teams themselves at the fundamental level. So I think they do bring something. They're not completely, but they're not going to bring things to your cap table. They're not going to bring to your advisory board the knowledge that an investment banker brings. They're not going to bring the knowledge that a sophisticated, by the way, a lot of fund managers are not helpful or sophisticated or experienced or anything useful, to be blunt. I mean, when I entered this industry, I could not believe how stupid many of my peers were. And I mean that, as somebody who's founded a lot of companies, many of them had no concept what it takes to run a company or how to build one.
Glenn, we deal with companies like that all the time. Where we get in, we're engaged primarily for the sell side, and we start talking to the majority, the private equity firm that's the majority investor, and we're just amazed at what they've missed, what they don't know about, how they've managed this company. But then we also know, and that's why we love doing the growth equity raises, because we know some great investors out there who really understand the sector, the industry. They understand how to run these companies. They understand what they need. They provide so many different services to the company, and it's not, that's what their management fee is for. But they're not charging extra for it. Their interests are aligned. Let's grow this. Let's grow this great company and have a successful exit, whenever the time frame makes sense.
Yeah, if you can find specialist investors or investors that have experience in the industry or even in operations in general, I think that again, there's no cookie cutter, right? You can go into private equity, you can go into venture, you can go into investment banking. Really doesn't matter which one you go into. You're going to find people who are competent and you're going to find people who aren't, right? And the same is sort of true in the celebrity space, is I guess how I would argue it. There are people that bring something to your cap table and there are people who don't. I certainly wouldn't go hunting them. It's just an impossible task. And they don't generally bring as much to the table as somebody who maybe has sold their company in the space before or has been involved in transactions or worked with customers, knows the industry inside and out. So many times I did a lot of government contracting, and so I'm doing a lot in aerospace. I mentioned that I'm doing a lot in aerospace right now, and I've got a company that's going to be going public here in the first quarter. And there's so much in government contracting that is an inside base. It's like only insiders know how it works. And if you build the company wrong, you can't even sell. Like you're going to you're going through, it's like something that you could do in 2 months will take you 2 years because you're going through the wrong channels and you don't have the right codes and you don't have the right partners. And so you need insiders regardless what industry you're in, you need somebody who's already been and walked that path before. And a lot of times you can get that from the private equity, the venture, and the investment banking teams. But again, it just comes down to their core expertise. So I'd like to talk more to you. I'd like to see what you guys are working on. That tends to be our area of focus, is kind of the middle of the country. So I think
Okay, I'd be
that'd
happy to.
interesting.
And
we've
we're
probably got 20 teams working with bankers right now.
so we're based in Austin, and our founders are former bulge bracket bankers who just, when they were doing buy side, they just saw the mistakes that the sell side bankers were making, which makes the buy side bankers' job a lot easier. And they said, you know what, we've got an opportunity here. And I mean, our firm is about 15, 16 years old now. I'm based in Cleveland, so you want to talk about middle corridor? That's about as middle corridor as you can get.
I got a couple of family offices in our fund that are out of Cleveland, and then my partner's in Austin. So I think I'd like to have a further conversation.
Yeah, I'll reach out to you offline.
Mm-hmm. What else do you guys want to talk about today? Anybody having any issues? Anything you want to?
Oh, I had one point, Glenn, about robotics, because you mentioned robotics as a kind of like an attract, but you probably heard that iRobot just went bankrupt. And I mean, what I see robotics, like China is a place where robotics is having massive economic impact. The U.S. is still reindustrializing.
Yeah, that's why
the opportunities aren't there yet.
That's why iRobot went under, because of their Chinese competition.
Right.
Doesn't a Chinese company own them now?
Yes.
Yeah.
Now they do.
Yeah. So when I look at robotics, I'm looking more infrastructure in. I'm looking more industrial. But the other place I would look at, again, we're talking about where would you put in? I said energy. Okay, I'd put a lot of energy in energy. The other place I'd put a lot of energy would be aging.
Yeah.
And so I think we've got this huge disconnect between populace in need of care and caregivers. And so there's going to be huge opportunities in robotics around that. Even if it's just monitoring. So we're doing a lot of, it's not really robotics, but sensor technology would be an extension of that. So we're doing a lot in our fund. And by the way, that ties into AI. So we're doing a lot of work around the remote patient monitoring. But I think anything that deals with the aging population. So for me, robotics would either be industrial, so highly commercial, or enterprise rather, and aging population. I wouldn't get into there's nothing wrong with it, but I think that you're in a race to the bottom if you try and go up. Literally, that was going up against China's manufacturing capability. So if you're going to go to a consumer-oriented small robotics device, it's just a race to the bottom. It's not a good economic game, I don't think.
Makes sense. Thanks.
Well, they would have been fine if the Amazon deal hadn't fallen through.
Right.
Yeah.
They turned it down.
Yeah, I mean, they'd have been fine, but I think that again, you're gonna see a product like that just march the margin's gonna get wafer thin.
To your point, Glenn, about aging, so that's an area I love. I do a podcast on that topic, but 10,000 people a day turn 65, right? So the population of people aging, and I think the baby boomers are going to start turning 80 very soon. Like they're going to be even older. So there's a huge population, and for products and services to service the aging population.
Yeah, I think that's a great area if you're making bets. It's going to be hard. Joe's going to hate what I'm about to say here, and please temper this. It's just the way I'm using language, but I think it's going to be hard to lose. I mean, it's going to be there. There's going to be so much need. There'll be plenty of crappy companies, but there's going to be an awful lot of opportunity to excel there.
Yeah. So
if I was building a company, I'd probably go there.
Yeah, when you were talking about aging, so I'm actually working on a new project now because, just to put it short, I've got teenagers with autism.
Oh, okay.
One of the things we've noticed, just me and my wife, is all the sensory products that are out there either look too medical or look like it's made for play school kids. So what we're doing is, and I've got teenagers, I know they're not going to wear anything that they don't like. So what we're actually doing now is you know, we're actually working on products which are sensory products, but they're actually made for adults. So it's meant to be discreet. So it's kind of like more like adult aging from, play school to teenager. So we're actually, and it's great because we can actually consumer test on our kids themselves. So it's an interesting space because the aging up, people don't think about it, but all those
Oh
products,
no. Yeah,
it's like, and it's
huge.
great. I have to say, it's great using my kids for consumer testing because they are so brutally honest. They
It
literally
doesn't
don't
hurt.
care what I think.
It doesn't, yeah, it doesn't. If they're autistic, it doesn't hurt either because they're
No,
definitely willing to give you their unfiltered opinion. This is an area the reason I react to this is several. One of our investors in our fund is a group called the Disability Opportunity Fund, and a big area of focus for them is autism, and they
yeah,
have many areas of focus. Another reason is we didn't invest in it, but one of the companies we look closely at that we became friends with that is part of their portfolio is a company that is called No Limits, LIMB. It's and they were a Super Bowl ad this year. Not they didn't pay for it, Google did, but they were part of the Google portfolio that Google put innovative startups on the Super Bowl, and that company focuses on it's a girl who lost her leg when she was, I believe, in high school, and so she created clothing that is designed to be functional and attractive and interesting to younger
Mm.
people. So that immediately resonated with me because I remember looking at their pitch deck and they were showing all of these clothes that were designed either not at all designed or designed for people with um, uh, artificial limbs, and how freaking ugly they were. And these kids were just like, didn't want to wear them. So that's why she had designed her own clothes. Um, and then the third reason I'm interested is we're trying to sell right now. One of our companies created, and one of the big audiences is severe autism. So they created a product that does real-time translation primarily for people who had a stroke or cerebral
yeah,
palsy or some serious neurological accident or disorder. But in severe cases of autism, there's communication challenges, and this
yeah,
software can in real time translate things that most normal people can't possibly understand, because when you say a word, the sound wave remains consistent. So if you say coffee, just because I don't understand what the heck you're saying, your sound wave is consistently the same, so that once it figures out what that is, it can translate. And so they built this translation layer,
that's
and
pretty cool.
yeah, so and it was
Yeah,
designed primarily for, honestly, for adults. So it's people, and it does like this, like a Zoom conference like this. It'll do in real time translation. Um, so it allows people that would otherwise struggle to enter the workforce or to just have a conversation with a vendor or a friend or whatever. And so those are three reasons why I immediately had a obvious reaction to what you were saying. So
yeah,
if you get that going, I would be happy to. There's a guy, Charlie Hammerman at Disability Opportunity Fund, you should probably talk to. He could be
awesome. So
very,
I'll hook you up on LinkedIn. Then when I think we're
yeah.
about 2 months away from getting the first
Okay.
prototype, and then I think we've got like a ton of products that we're working on. So we've got like tons of ideas. So it's kind of fun to
Now,
work on.
the other thing too, by the way, real quick, sorry people to hijack here, but the other thing real quick is AARP, which is the, American Association of Retired People, basically, right? Um, they have an innovation fund, and they have been doing some work around disabilities in younger populations moving into the aging population. So they see what Joseph was talking about. They see this massive migration, and that's not just a bunch of normies. It's a lot of people with a lot of different things going on. And one of the
Yeah,
areas of focus is autism and having independence into adulthood. And so AARP is looking to invest money, and they've been doing quite a lot of that. I think they're in 5 or 6 of our deals. So that's another one you should be
yeah,
kind of trying to dig into a little bit.
And
awesome.
they do a lot of promotion for those companies in their fund. They bring them to their
Yeah,
conference and stuff.
yes, they do.
Yeah.
And they can get them
Awesome.
into state government programs, so you can get into, and again, this is an interesting dialogue for everybody else on the call too, because this is an example where you might be focused on high school kids, you might be focused on college kids, you might be focused on whatever, but there's an opportunity right now in aging population as well. And so you could potentially get capital, but you could also it's so much easier. Like it's not necessarily easy to find somebody that's going to get you into high schools or get you into colleges or get you into some young organization. But right now, it's very easy to get into assisted living facilities. Not easy, but comparatively easy to get in through some of these state programs, through AARP, through some of these innovation initiatives going on. It's much easier to penetrate that market than it might be to go after, and you could do both in parallel. I'm not suggesting, I'm just simply saying you might look at how you could potentially take whatever you're developing, work with somebody like AARP who has all the lobbyists, all the connections, actually has I don't know what the relationship is, Joseph, but they have a bunch of assisted living facilities that they're not like owned by AARP, but they have the ability to move product into them. And so you can penetrate the market easier. Just
There's a lot of private equity in the aging.
Yeah, I was going to say venture.
Sure.
There's a couple of venture funds as well that focus exclusively.
Yeah,
on
Alan
aging.
Patrikoff just put together
Exactly.
former founder of Greycroft just put together, and he's a partner in a fund I'm in as an advisor. He just put together $100 million, pretty small, but $100 million fund for aging.
Yeah,
Alan, guys, it's
who I was thinking of.
What's that?
Alan's who I was thinking of. Yeah,
no, that's just such a hot market right now. If you can figure out, and we just spent a bunch of time saying don't chase a trend. That's not chasing a trend. That's taking advantage of other avenues that are already open there. Politicians are already looking at it. Money's already looking at it. So you can penetrate the market quicker, easier.
Yeah, it's more to do with like data. That's where the initial I kind of stole the idea from Harry Potter because they came up with adult book covers. So if you're an adult, you don't feel the need to be embarrassed on a train
Oh,
reading.
how funny.
That was
Okay.
like really,
Good for you.
And just to your point, I'm at one of your points about diversity. I'm actually a descendant of the founders of Unilever.
Oh, no kidding.
Yeah.
That's
Yeah.
a pretty damn good family.
Yeah.
When you talk about diversion of funds, because it was a family, it was four families that was originally started out, and my family was one of them. And basically every single member had 10 kids. So
Wow.
all the investments, I'm like come from the runt of the family because my grandfather's like the youngest of 9 kids, and his dad was the youngest of 9. So we've literally like got no shares in that.
I'll tell you, there's some big I don't know if I've ever talked with this group about it, but one of the families that I've hung out with and had some fun conversations is a Weyerhaeuser family, which is an old American family known a lot for logging and lumber. They do almost 1,500 tax returns a year. That's how big the family.
Wow.
That's how,
Wow.
just to put in perspective what legacy, when Joe talks about legacy and generational capital, that's what, crazy. Anything else you guys want to talk about? We had
Yeah,
no great grand agenda today.
Oh yeah. Eric's had his hands up for a while.
no, I'm just being patient here. Gosh, now I'm going to ask you a question that's boring compared to everything else. But it's this notion about startups and traction. And, it seems that they all have their own definition of it. But I'm curious about, what you've seen, Glenn, and you're exposed to this, Joe, also, of what they're calling traction, but really turns out to be noise or not sustainable. And the reason why I'm curious about that is one of our clients, it's a VC, and they had us analyze 30 of their potential portfolio companies, and what they were saying, this one's hot, a lot of traction. We looked at it from the people side, and some of them were sustainable and some of them weren't. So I'm just curious about your experience when you're looking at a company, a startup, and it says we got a lot of traction. What have you found out to be total BS and what's real?
Well, we had, yeah, I mean, Joe and I have talked a lot about this separately as he's been, this kind of a shared view of what's important in investing. We had a lot of conversations about how he has attacked things and how my fund attacks things, and there's a lot of crossover. There's some things we do differently, but there's a lot of crossover. And my funds, I guess I should say my funds, we had pretty hard parameters around traction. So like it was a big part of our thesis. And I used to say that there are lots, you can have obviously revenue is a component. There are other things that can come into play. So you can have distribution, you can have partnerships with some large distributors that give you, we were just talking about AARP and getting into assisted living facilities. There are, medical distribution partners, there's industrial logistics, 3PL distribution partners that are out there. There's all kinds of partnerships you can have, but I downgrade those dramatically. Bullshit metrics like honestly, most user engagement metrics are just generally bullshit. I'm not saying they're not worth anything. 20 years ago, they were valued at a very high level. When social media became a big play, they became valued at a much higher level, but we at Quake have never valued those particularly high. I came out of the ad tech industry, built one of the first, biggest ad serving companies in the world. And so we had all these bullshit metrics like dwell time, just to give you an idea of like somebody hovers their mouse over something on a page. That's like dwell time, or they stay on a page.
I'm surprised Joe hasn't jumped into that conversation, right?
Oh, no, it's just garbage. Those are garbage metrics. We've talked about it. Like, so at Quake, we a lot of the stuff that people talk about, Eric, we downgrade dramatically. We basically don't give it any value at all. So it's a tough one for me to answer because honestly, and I think the market has come this way too. 5 years ago, these bullshit metrics mattered a lot more. I said 20 a minute ago, but I'm talking about like the lump of all of this crap that exists in terms of, weekly, if it weekly visits, time on site, social media shares, whatever the hell, take all of those types of metrics that are not necessarily revenue. 5 years ago, those were hugely important. And as we've gone forward in time, every year they become less important. And I've been telling my founders this last year, and I don't know where Bonnie, Joe, and Joseph land on this, but this last year I've been telling my founders, get your ass focused on, it's not a big deal for our founders because they're almost all cash flow positive. We have crazy high survival rates for a reason because we focused on revenue and line of sight to profitability, or cash flow break even, I should say. And so it wasn't a big conversation, but I started last January saying, you better get your ass to cash flow break even, significant revenue production. And the reason I was saying that is nothing other than the fact that that's what a lot of VCs are now moving to aggressively. Well, part of this is because they got their ass handed to them over the last couple of years on losses. And this is something Joe and Bonnie and I have spent a lot of time off of these calls, talking about. Like the amount of fund failure is insane. It's just absolute insanity right now. The size of the deals that we talked about earlier on this call, I mentioned Quibi, that company cratered. It was Meg Whitman and what's Katzenberg? I don't even remember the director, producer.
Jeffrey Katzenberg.
Jeffrey. Their combined entity with all of the celebrity, help they could possibly get, completely cratered, and multi-billion-dollar valuation, hundreds of millions, if not $1 billion raised, and they burned it in a year and a half. And So all these funds, and I'm not going to get into who was in that deal, but it hurt those funds royally. I know what their portfolios look like. They're in some of our deals. And so you just have there's a big backlash to that point, Eric, these useless metrics that used to be perceived as helpful or interesting or meaningful. They're not viewed that way right now.
Mhm.
I don't care what anybody says to you when you go into a meeting and sit down with a VC. They really care about your revenue. They really care about your line of sight to profit. They really care about your margins. Which, by the way, that's an important metric too. They care about your churn. That's a really important metric. Okay, that if I'm picking one that matters, that seems like it could be on the fringe. Churn matters a ton because it's way more economically productive to keep a user than it is to go find a new one. It's more than 2x.
Yeah, the
different.
CAC is significantly lower.
So these types of metrics are the only ones that matter now. Economic metrics. I don't care what they're saying to you. Like all that bullshit that they were talking about the last 3-4 years. And there's a lot of really political stuff that I'll just leave off to the side too. None of that is happening in the back rooms of the investment committee now. The
So
investment
Glenn,
committee.
what we hear all the time now is it's called durable growth. And because Silicon Valley came up with this rule of 40, especially in enterprise SaaS, which used to be as long as your growth and EBITDA totaled 40%, you were fine. But that a lot of times that meant you were growing at 70% year over year, and you were losing 30%.
Yeah.
And that was okay. Well, now it's got to be, talking about the line of sight to.
We'll make it up in volume.
Right, exactly. And it's funny because it's a new turn on an old adage. But one thing you said that you have to be careful about, because you said two things I agree with. One is one I agree with, one I didn't. One is obviously churn critically important, because that's going to foretell whether you can efficiently grow your company. But the other you said about the usage metrics, and I think you're talking, the context I heard was more on a consumer basis, and especially if you're talking about ad tech and how the consumers are, time they're spending on a website. But when it comes to enterprise SaaS, usage metrics are critically important, because they
I hope, but that translates directly to revenue. And
revenue and churn, because it's also it's gonna be a good predictor
Loyalty.
of churn. And
Yeah,
like you
so
said,
you don't
I've
need
been
you don't
amazed.
need that. Yeah, you don't need that metric in enterprise because you got two other better metrics that'll
Well,
give you the
but no,
outcome
but if it's a predictor of churn, you're
for
amazed.
future.
I've been
Yeah.
amazed by how, again, we go into companies, and the professional investors in these companies have never looked at the usage numbers and don't understand why, even though they've got good organic growth, why their churn is starting to get where it is, and they've never looked at the usage numbers. Say, yeah, we sold 500 seats, but there's only 50 unique users. That's going to tell you something. You're either going to have complete churn or significant reduction, down the road at some point, and especially now where everybody is evaluating how much software that they're using in their operations, and they're rationalizing that and determining where their spend should be. Because it used to be, if there's a new product came on, you bought it, but you didn't look at what else did you have that you were utilizing. Was there, they'd have competing products that one side of the company's using one, the other side of the company's using the other, and they've got licenses for everybody in the company.
Sure.
And just crazy stuff
No,
going on.
I think that's actually a really good point. I was definitely talking more about consumer, social media, outside external engagement. You're 100% right. I do tend to downgrade those. It's funny when I look, again, another thing Joe and I have talked a lot about. So Quake's investment thesis is completely on its head compared to most venture funds. I'm not entirely sure that it's worked for us, but there are some chinks in the armor. Most venture funds start with people. They look at the founder. They're really focused on the founder, the person. Then they kind of go, there's three components. There's team, I'll say founder. There's technology, I'll say product. There's traction, That's generally the order they go in. We flip that entirely. We go, well, not exactly, but we go traction, team, technology. And that may seem totally weird. But the reason is the traction proves to me the other two. So I don't spend a lot of time thinking about it. If you have traction, then you've got adoption and you've got product market fit. If you've got the traction I'm looking for, and there's really specific metrics I look for, but if you got the traction that we need to trigger a buy decision, as Joe might look at it, then that means that you've already got product market fit, you've already got adoption. That also tells me that you've got a team, to your point, Mark, that understands a lot of, not necessarily, as you pointed out, but should theoretically understand a lot of those components of like, why are they getting churn, their general go-to-market, their general pricing, their general partnering. Like a lot of those things are resolved. We have had some problems where there are things I didn't consider that are not factored with the team there. Assholeness is not factored in that very well. And neither is failure to exit. You know, the like the inability I was talking about earlier to figure out how to get out of the deal is not necessarily in that model. But what is in the model are general decent operating principles, decent culture inside the company, good sales, typically solid product, good MVP, user loyalty, low churn. All of that is represented up in traction. So that's how we attack it. We tend to attack from, you know, I guess it would fit Milam to a degree, Eric. We go to the data and allow it to answer those other, you know, what are subjective questions. We allow the data to try and get us there objectively. That's how we attack it. But you raise a good point. I do want to be clear, Mark, what you're saying about enterprise is 100% true. No question. Engagement matters. It's a whole different ballgame over there. That's not really what I was getting at, but
no, and that's I knew you weren't because it was
Yeah.
clear, but I didn't want people to take your statement.
no, I think
and just
you're
assume
absolutely
that
right
was
to jump
applicable
on that.
with everything.
Mm-hmm.
Thank you, Glenn.
Anything else? I know we went over our time and I apologize for the what should we say, mess up earlier?
Oh,
Sorry about that.
I take some of that blame.
I
Yeah,
just want to know how you like. What did we? So I think we didn't have. You're the only woman on this call today. I think.
I know. I know. Is that wild?
What happened in your outreach? What did you put in the message?
I don't know. And I invited women too.
Bonnie's used to being in a room full of men by herself. She can,
That's
and
true.
she holds her own.
It's been this way since
yeah.
Web 1.0.
Right.
Or
That's
just
you always
gonna
talk
say-
about that, Bonnie.
Or Joe and Greg have just alienated the other women out there.
Yeah. I don't know. They get so disheartened. Women give up faster than men. I will say that. I know you have a lot of bad-
That's not 100% a bad thing. That's an interesting topic. I know we're out of time. Just something to ponder later.
It is.
It's not always right to stay in a deal. It's not
Well-
always right to keep pushing.
It just depends on the reason that they exit
Yeah.
early. I mean, you know, that you really have to look at because, you know, fail fast. Everyone, you know, that's
Yeah.
certainly a good motto, but gotta be for the right reasons.
Yeah, that's a whole interesting topic, and it's very controversial.
Yeah. And I know
People
you
get
have
very upset.
a lot of companies in your portfolio where the women are the founders. I know that.
Yeah, we had some of the highest ratios, and again, we had no. Just to be clear about that, going back to the data, and I know we're over time, but because we focused on data and not anything else, really, we ended up with we had 10 times more female founders than the average fund, 6 times more Hispanic, 6 times more Black, but zero focus on any of that. It was just simply because, well, one thing you do find, I will say, in some of those populations that's interesting, some of this is anecdotal, but some of it's not. They do have a lot less. This is not anecdotal. There's tons of proof. They have a lot less access to friends and family capital in general.
Yeah.
A really wild example, if you took a black woman and a black man from the same family, the black woman will raise 2 times less money from friends and family than the black man. Okay, so there's no there are actual examples, like lots of research on this. So they have less access to capital in certain diverse groups, regardless, how you want to slice or dice that. And so what's interesting is that when you look at those, and this is more anecdotal, we didn't put any like we don't do any weighting around this, but I just have noticed this. If you take those groups that have less access to capital, they build a lot more like we did in 1996. They bootstrap a lot more. They have no choice. They have to.
Yeah.
They bootstrap a lot more. They tend to be much more efficient. So one of two things happens, and more often than not, there's two scenarios. They either get money from around and they absolutely blow it, or they get money from around and they're really, really efficient with it. We've seen a lot more of the latter. We have seen both, though. I've not seen any middle ground. I've not seen any scenario where they're just kind of relatively measured, some mistake. Like they're either still living in their bootstrap mentality or they blow the money. Most of them live in the bootstrap mentality, but we have seen, they do grow very quickly because they just having a little bit more capital, they're able to really supercharge the business. So there are some sorry, we're off on a tangent, but Bonnie, you're right. We have a lot of that. There's a lot of interesting data because that's my background is data science. So I spend a lot of time looking at that. It's fascinating crap when you dig into it. And we have seen, I would not disagree with what you're saying. When I look at the founders, we actually have done some research on that. They do have a tendency to step away more. They also tend to have other obligations, which make that more challenging. Like they tend to focus they have the family plays a huge role.
Of course it does.
I'll just leave it at that. And the way that they view that obligation is very different.
So, Joe, anything to add?
Yeah, this is a topic I've spent a fair amount of time on.
Yes, you had something.
Terrence O'Dean is the academic expert on this topic. He's a professor at UC Berkeley. He in the 90s, he wrote the first academic paper on gender biases in investing. And I actually met with him. He was at UC Davis at the time and went to his office and met with him on this. If you look at the work by Jordan Peterson, or I love Heather Heying, who's an evolutionary biologist and the wife of Brett Weinstein.
Oh.
She writes about the female gender through the evolutionary lens. And they all kind of come to the same observational conclusions. And it's very relevant to what we're talking about. Women are, by their very evolutionary mandate, risk managers. All right. So their reaction to things are from a risk management standpoint. Men are risk takers. That's our job, right? To be the alpha breeding male, we have to take risks. Women are, by their very nature, risk managers to protect. We'll apply that to some of the data we're seeing on, female-led public companies outperform male-led public companies. That data is pretty clear on that. They actually outperform by the usual metrics. Why is that? Well, they're better asset risk managers. From a pure investing of assets, risk management is the best first lens to apply when you're managing existing assets. Okay, that's just a fact. It's why most VCs that are dudes underperform, because they're taking undue risk because of the Dunning-Kruger effect. They're overestimating and over-indexing on their actual abilities to spot hot deals, because that's what the evolutionary mandate is, to take risks so that if you get the big win, you get the big carried interest and you get laid. right? I mean, you can bring it back down to that context. Years ago, I was at an event in Denver, and it was an impact investing event, and Kauffman Foundation had sponsored it. And they did a presentation, and this is a room full of impact investors, which I was like one of three guys, and the other two were gay. All right. In this impact investing event. And the Kauffman folks stood up and talked about this issue. And they said, of the percent of female-led startups that are seeking capital, venture capital, angel capital, what percent of those seeking it actually get capital? Anybody got a guess? Give me some numbers. Throw some numbers out.
I think it was like 2.3%.
No, that's the total dollar amount that goes to female-led startups. It runs between 1.5% and 2.5%. So let's use 2% as the total venture dollars.
What was the question?
Venture dollars, about 2% goes to female-led startups. That's a fact.
And it's down from 2.7.
But of the percent of female-led startups seeking capital, what percent of them get capital?
I don't
Throw a number out.
5%.
Anybody else?
2.
No, it's going to be horrible.
According to the report that Kauffman offered.
Oh, no, it's actually not going to be horrible. Okay.
It's be high. 30.
Yeah.
According to this report, 10%.
Oh.
Okay. Of female-led startups seeking capital got capital. Now, what percent of male-led startups seeking capital get capital?
35.
Oh,
That's good.
This is the issue of isolating bias, by the way.
no, it's going to be terrible. It's going to be absolutely horrible.
5 to 8%.
Male founders.
Yeah.
It's 10%.
I would have thought it'd be worse. So it's even
It's
it's
10%.
balanced. Okay.
Where's the bias? Now, the fact is 2%, give or take, of the dollars go to female-led startups. But there's no bias when you look at the percent. So what's the issue? It's a denominator issue. There's not nearly as many female-led startups. And the typical business model that they're seeking capital for, they don't ask for big chunks of money.
No,
They're
the
very
problem.
consumer-oriented. They're very lifestyle-oriented.
Yeah, they tend to do. Yeah, they
not-
tend to be different types of startups. There's no question.
Right. They're not capital intensive. So that's the issue. And that's logical from an evolutionary lens, from Terence O'Dean's work, right? They're not as blustery as men over raising money because it's big. You get the big vanity metric of we just raised a bunch of money. And then they fuck it up. Men fuck it up because they spend it poorly. Right. So like I said, this is a very important topic because to me, the issue is where's the bias? There isn't bias, actually. There isn't bias. You talk about the Black family. Now, that's a very specific situation. I don't doubt that to be true. That's a cultural issue, and that there's a number of things in there. But this issue of
and that's friends and family. Friends and family is a whole different animal too.
That's different. That's right.
Because you have to look at the socioeconomics of the class that is looking to raise the capital, whether you divide it however you want.
Yeah.
One thing I would say quickly, Joe, is that there is one group that is pretty heavily discriminated against. There does seem to be a lot of data. I also have a lot of anecdotal. No, old. It's the people on this call largely. Anybody over the age of 40, 45, somewhere in that window, is honestly should probably be promoted, because they probably, if you were looking at a team, would have experience, would have network, would have, access to capital, all sorts of different things theoretically, but they underperform.
In terms of getting funding rather than.
Well, the proof is not necessarily even in that. For me, the proof is evaluation. When Mark was talking about where he hunts, and I said, well, we hunt in the middle of the country. We're in these off markets. Well, the other thing we do is we hunt old people. And the reason is because when we started looking at valuation analysis, we realized that old companies with shit tons of traction had crap valuations compared to their peers with much less traction. So exactly. I can tell you with certainty that the valuations don't align. I mean, you've often heard me talk about this one company called Baby Quip, do about somewhere around 20 million this year in revenue. Founder was a former founder of Match.com. Female founder was, I think, 56 when she started raising for it, based in Silicon Valley. It had 3 significant exits prior to this. Match was just one of them. And had $1 million in revenue by the time she went out to raise capital, could not raise money. And everybody's like, oh, she's a woman. I said, it had nothing to do with her being a woman. She's 56. That's why she couldn't raise money. Being a woman might have played a role in it. She's got, I think a big part of it too is she brokers no bullshit. So she'll go in and meet with a VC and tell them how stupid they are.
That's the issue. That is the issue if you look at the early stage investors, and again, this is a heavy, broad brush, but it's accurate. They don't know what they're doing. They're largely imposters. And somebody that's got seasoning and got experience and got knowledge
just sniffs that out right away.
Oh my God, they don't want any part of her because they're going to make them look like the imposters that they are. That's the problem with a lot of the conversation here has been around. I'm just sitting back listening to everything you guys are talking about is just the inherent flaws in the venture industry that you've heard me rail about forever.
Greg,
we don't try and fix a system that is unfixable. You got to present a new system.
Sorry.
Because the existing system is continually perpetuated by a lack of professionalism, no barrier to entry. You have boom and bust cycles. This is, I'm almost 30 years studying it. It's the same behavior that just gets repeated by a new generation of investors.
I was just reading it. Oh, go ahead. Sorry.
The industry is never professionalized. They don't know. Matt Harris, some of you may have heard on our office hours, Matt Harris is coming on board in our company. Glenn knows him quite well. Matt's got a great resume, but he spent 3 years, very intense years with Tim Draper, Draper Associates, after having worked in private credit with Blackstone. And his dad's a big time institutional investor in the public market. Matt understands institutional investing, serious investing. Yep. Then he goes to work for Tim Draper. And he looked around and he went, wait a second here, this can't be real. What he saw inside Draper and Associates was shocking to him. But he told me the story. He says, it must be just unique. So because of his access, he called his peer equivalents at some top tier venture firms because he could, right? He works with Tim Draper, so he made calls to other venture firms in Silicon Valley, top tier by brand recognition. Simply asking, what's your process inside your firm in making investments? Let's swap stories. Let's share each other. If your process and ours aligns, he said he spoke to 15 firms. Not one of them had a process to make investment decisions. It was all eclectic. It was all at the whims of the head of the organization or the lead GPs. The cult of personality is what defined their investment process, Tim included. He gave me some very specific examples, and it just is. And that's the system that needs fixing. Because look at what Glenn did. He did it instinctively. He just did it based on data. Forget it, it was meritocratic. And
same way you run a company. I just did it the way you run a company. How do you figure out how to take a product to market? How do you figure out what markets to go after? How do you figure out what features to add? It's no different.
Not the venture industry, particularly the early stage. And I again, that's where I focus my attention. I'm not trying to fix late stage. I'm not even studying it because it's in play and it's devolving into a very natural progression. Those guys want to become Goldman Sachs. That's all they're doing. They're building big platforms to become Goldman Sachs. It's really obvious, right? But the early stage stuff is where the greatest number of entrepreneurs are impacted, the greatest number of investors, angel investors, and others get fucked. Pardon my language. That's what needs fixing. And we're getting ready to fix it, folks. I got to tell you.
Let me share something. I know Joseph is going to have to cut us off. Real quick, let me share something I just think is amusing.
You can
I'm
keep going.
advising.
You can keep going.
I'm advising 3 funds right now. 3, you know, either existing funds launching a new fund or new funds that are launching. They all have considerable amounts of capital. They've asked me extensively about what you just were talking about, Joe, process, metrics like Mark was talking about, how to build a metric driven process, how to score, building scoring tables, how to build potentially AI, all these different things you and I have talked a lot about, Joe. They've had tons of conversations with me. I go through it with them. They come up with a policy driven approach, whatever you want to call it. They come up with this whole thing, right? And they've all now made new investments. And every one of those investments, and despite all of my objections, comments, whatever,
Yeah. I know where you're going with.
They're gut driven, and like they just threw
Yeah.
all of that shit, like everything we spent 6 months talking about, they threw it out the window and they just went with their gut, despite
Now,
having
This is critically important, but it's also not unique to the venture industry. Now, let me give you a case study. When I managed money, you've all heard this, and it's not bragging. We were, and I look at myself in the third person, and how the fuck do we do that? We were the top performing large cap core manager, quant-like, all data driven, right? I researched the process, designed the process, sourced the data inputs, and then we executed it with unbelievable aplomb. We'd spend an hour and a half a week an hour and a half a week in the research meeting, making all buy and sell decisions and executing them through our back office trading system. An hour and a half a week to deliver first quantum results. That's a staggeringly efficient process to deliver the results we did. Now, our key data vendors, we had 2 of them. Both of them gave us their personal money to manage. We were the best in the world at all the people they sold their data to. And the key one, this company that's now a part of UBS, Credit Suisse bought them back in 2002 for $100 million. That firm is called Holt. And they asked me to go train their other customers how I use the Holt data, much like what Glenn was doing with these venture firms. They struggled. I had much better performance. They asked the data vendor, hey, who else uses your data that we could learn from? They said, Joe was happy to help you. I actually went to my competitors, they're not competitors, and showed them exactly our process, our data inputs, how we used it. They still didn't adopt it.
Yeah.
So this is a human condition issue, right? This is a behavioral human condition issue. And implementing process is low-hanging fruit for excess returns. Any decent process will absolutely deliver excess returns, public or private markets. It's a fascinating phenomenon, but you can't fix stupid.
no,
But you also can't fix the basic human tenets of ego, of the vulnerability
and
of the
your
human
pitch has
to
to
the limbic brain.
yeah.
So you have to architect solutions, guardrails, protections against the very natural human instincts to devolve into ego, and greed and fear, all those limbic components to how the brain functions.
But the
You
founder
have
has
to
to
build those
almost go
guardrails in.
the founder has to almost go the other way, Joe. The founders on the call. So, we can bitch about the industry, but the industry is the industry. So the founders have to do 2 things. One, to Eric's point earlier, I think you build a metrics driven, traction driven pitch largely, but you have to kiss their ass and appeal to their limbic brain. You have to. So, because that's how most investment decisions are still driven from this.
That is correct.
So
that's right.
you have to understand what Joe is saying and flip it around and use it in your pitch.
That's a
There's
good
a
point.
those of us who've been very good at raising money, I've spent a lot of time analyzing why I was successful raising capital. And it's because I figured out that psychology in reverse. So you do have to figure out how to use that.
Yeah,
Use it against them.
the hardest thing is from a startup side, is trying to figure out and trying to understand their biases and their unconscious biases, because that drives everything else. And that's not, a lot of times that's not observable, and it's guesswork.
Well, therein lies the problem. It's an inefficient market, without a doubt. That is the friction in the system itself. You know, when Glenn, you say it's easier to raise money, I agree and I disagree at the same time. Because
there's less noise too. I mean, there was less noise when we were out there earlier.
There you go. That's exactly right. That's what the point I was getting to, is that there may be more nodes of funding, but the actual velocity of activity coming from those nodes and the relative sophistication of those nodes is greatly diluted as a result of that. Right? These angel groups are a colossal waste of entrepreneurs' time. Colossal waste. Now, if you become a hot deal, sure, money can flow much easier, but you have to play that silly ass game to appeal to that limbic brain from a diluted investor pool.
Well, and they're great. To your point there, Joe, they're a great, the angel groups are a great learning ground for the psychology of investing, because a big part of it is herd mentality. And I think that's true for VC funds too. Everybody's chasing the same, it's sort of the hot topic, right? The herd moves, the FOMO, hot topics. It's all the same stuff, right? When you look at an angel group and you go and pitch an angel group, you see it in real time. Like, you don't have to go do 20 meetings across town. You see it in one room in real time. You see how one person can change, either good or bad, the entire flow of that pitch. One person in that audience changes the entire outcome of whether you get money or don't get money. The exact same thing happens with venture funds across town in multiple pitches. You don't see it, but it's the same thing. They're all moving as a group. They're moving as a herd.
It's a stunning herd mentality. And this is the contrast I had as a money manager. Again, having managed money and watched my peers, because I designed the process and we executed the process. It was designed as a team approach. That is the optimal decision-making model. And so that's how we did it. I wasn't the decision maker. We had a process, and it was three of us on the research team at all times. And I posted our numbers in these databases to get access to the people I wanted to compare myself to, who I was benchmarking against, the firms that had great long-term track records, that were known to have rigorous processes: Neuberger and Berman, Sanford Bernstein, Capital Research, which is the American funds, Dodge and Cox. I mean, these are quality firms over decades. That was who I was benchmarking myself to and comparing and tracking our performance and those granular performance statistics. And they all blew up. Part of the reason we became number one is they blew up during the 90s. They abandoned their disciplines. And that was such a huge lesson for me in understanding the very thing that you can control will deliver the results for your investors. You don't have to have an information advantage. It's basically, I call it a process alpha, but it's actually discipline. It's simply that. And that the venture industry is such the Wild West that, again, this is, I mean, I know I'm preaching the choir here, but y'all heard me rail on this sort of stuff. But that's the one thing when you ask about what's going to be hot, Eric, with what's going to unfold with our company, we are going to change the venture industry. That is going to happen. We've got Ray Dalio who's going to invest in AngelSpan. I'll give you some of the names. Just Josh Harris, one of the co-founders of Apollo, is going to invest in AngelSpan. We'll probably get David Booth from DFA. Huge. He's the inventor of the index fund. Him and a guy named Mac McCown, when they were at Wells Fargo Securities back in 1970, they invented the index fund. And David Booth is going to be. So when that level of investors, global institutional investors, gets on our cap table, that's going to send the signal that this is the right way to do it. for the adults in the room, the adult investors and the adult capital, what we call legacy capital. And the legacy entrepreneurs, legacy capitalists that are entrepreneurs like you, Eric. You're a legacy capitalist. You're third, fourth, fifth, whatever. Glenn is a legacy capitalist, right? That's who's going to win next, because it's going to be process driven. It's not going to be the cult of personality driven. The whole celebrity bullshit is going to be viewed now in its proper context, because there will be an alternative where the adults are at the table. The adult investors are at the table, as evidenced by their participation, and then all the research that went into the platform, all the papers that I published. That is what's going to happen. If you ask me what's going to be hot, this is, I know, completely self-serving, but I can tell you it's going to happen now, because it's the last piece of the puzzle is in place for our platform to finally get the traction and the awareness that people are good. The money's going to come flowing, and it's going to dwarf the idiot money that's been dominating the entrepreneurs, the beauty contest that entrepreneurs have to go through.
Well, and to that point, Joe, and you and I have talked about this as well, there really hasn't, venture has been a redheaded stepchild of the asset class, when you start looking at
and
it.
Correctly
Particularly,
so.
yeah, I'm not even
correctly
arguing that. Yeah, not arguing that at all. But that's been the problem. Like when you say real serious money, it hasn't honestly had real serious money. Like it's so that is going to be a pretty significant shift if what he's saying happens. That's going to dramatically change the amount of capital available.
It's going to, and it literally, when I launched the predecessor company, the guy that was the scientist behind that data vendor that I used to manage money so successful, Bart Madden's his name. You can look him up. He's written numerous books. He's a PhD in finance, egghead smart guy. And I was telling him about Angel Legacy. And he said, Joe, I heard you started a new company. What are you doing? And I told him about Angel Legacy and the problem with the same conversation 25 years ago. And he said, oh, really? Well, tell me about what you're doing. And I told him the components of that version of that attempt. And he said, Joe, if you pull that off, you lower the cost of capital for entrepreneurs. You lower the equity risk premium investors view the asset class.
Mm-hmm.
You move the efficient frontier on it up and to the left. And you'll change how entrepreneurial capitalism is practiced. You'll do for venture what Michael Milken did for junk bonds. That's exactly what's going to happen. That's exactly what just took 25 years. But that is exactly what's going to happen, because the whole rules are going to change. When meritocracy becomes the driving factor, you're going to have diversity like Lynn's portfolio. You're going to have better survival rates. What if you simply free up the time for entrepreneurs that they chase money from these idiot investors, and they can apply it to their adult business acumen to build the business? What's going to be the survival rate of startups? The batting average, if you will. It's going to go through the roof just by freeing up that time. And if you execute well and the right metrics are being measured, then the money will be there waiting for you, versus you having to go start from scratch again every fucking funding round, or have to pander to the KPIs of the people in the cap table so they can get an outsized markup so they can go raise their next fund. There's been massive perverse incentives for startups to adhere to metrics that are in the VC's best interest so they can get a big markup to go raise their next fund. It's not the best metrics to run your business.
I just got a call literally last Thursday. I had a call from one of our founders overseas. He's got a great little company, will do about 25 million in revenue this year. Highly profitable, 75% margins. And he's getting pressed by his venture funds, his investors, to do another round. And they want him to do a huge markup on his valuation, and they want him to raise about 3 times, maybe 4 times what he actually needs. And one of the reasons for that is because you can't jump your valuation ridiculously and raise $1 million, right? I mean, you like that like just, what do you give it away? Like, nobody wants to buy that round. They don't want 1% of your business or whatever. So he has to raise a lot of money to justify the valuation, or they kind of fit together.
that they want to get the mark
to
up
mark
to go
the
raise
book
their,
up
Yeah.
just so that they could get a markup on their books. And he was like, calling me up to figure out how to navigate that, and is that, and also just like, is that normal? Is that a good idea? I'm like, hell no, it's not a good idea. That is entirely self-serving to the fund. But it's funny you mentioned that. That's a real problem the founders have.
it's a huge perverse incentive laced inside the existing funding infrastructure for entrepreneurial capitalism. It's a huge flaw. And you end up chasing these silly KPIs that has all the optics that this investor thinks is relevant, so they can justify writing a check. Really, they're only doing it because somebody else is on the cap. I mean, it is such a broken system. And when you fix just that, where the cost of capital comes down and the equity risk premium comes down in the eyes of the investors, you raise the velocity of activity. Also from a new slice of investors, more sophisticated investors, which aren't aligned with that same markup bullshit or the existing venture industry's typical.
Yeah, by the way,
incentives.
that's where Quake fails. That's where your legacy fund is going to Quake. And I love our investors, but we don't have those. We don't have necessarily the right investors. We have family offices, 75 of them. They're great, but family offices don't fully comprehend and are not particularly diversified into startups and early stage. It's not an area that they are particularly familiar with or comfortable with. They're not long-term. They don't understand the long-term ramifications of that. And they move into alternative asset classes as a diversification strategy, but they don't understand them all. And I don't need to get, I don't want to waste everybody else nobody on this call particularly cares about that other than maybe you and I, Joe, but I just think we made a mistake there. I'm just mentioning, I think that's going to be good for you. The people you're talking about are going to be long time horizon, value add.
Legacy capital is a different motivation. And that's the trillions and trillions of dollars that's out there latent and is seeking this path, but they won't do it stupidly because they don't care about the cool kids club. They don't care about investing on a cap table with Ashton Kutcher, or Will Smith, or fill in the blank. That is so pedestrian to them. It's like, really?
Yeah.
And that
I gotta be careful.
It's just the whole conversation around this cult of personality. That's the beauty of legacy capital. It's different, and it's huge. It is fucking huge.
If he's right, Eric, if he's right about that, I mean, and I don't mean no disrespect with that, Joe. It's just a hard lift. Like any startup, it's a hard lift, right? And you've been working on it for a while. They're always a hard lift. If you succeed, I believe you're absolutely right. It will transform the industry, and the industry needs transformation.
And it needs transformation. Yeah.
And then you'll see a lot of copycats.
You'll see the lookalikes, and they're going to be a lot of the big brands are going to try.
And everybody wins as a result of that.
If they do it right. If they do it right.
If they don't bastardize.
Yeah. Of course they won't do it right. They'll do it their way.
Of course.
That's
but
it'll be better. It won't be right. It'll simply directionally be better. And that's the good news. Right? The Bill Mason will become the standard. That will be the metrics. It will become the standard.
I'm turning into a pumpkin in 7 minutes. So
I know I have another call too.
So I'm gonna have to bolt, but
I want to thank you guys and everybody else, and I wanted to wish everybody a happy holiday and a wonderful new year.
Same to you. Same to you all.
Yes, thanks.
Great conversation. I absolutely enjoyed it.
We're having office hours the day after Christmas. We're hardcore, folks. I'm just telling you.
Not me. Not me.
Joe, every office hour after Christmas and Thanksgiving, it used to be a time of fun because there were only 5 of us and it was comedy, stand-up comedy. Now it's like 50 people. What's up?
35 people the day after Thanksgiving. Yeah, Christmas will be interesting.
Crazy. That's crazy.
Well,
Lucky.
we had some Europeans that patted that because they don't celebrate Thanksgiving.
Hey,
so it
I'm on
was
here
pretty
today.
funny.
Yesterday was my 60th birthday, and
Oh,
I was
happy
up late
birthday.
Hey,
and I was up late
really?
last night. Yeah, yeah. And I
No
was up
shit.
late last night, so I had to get up. I got up this morning at 5 a.m. So,
You're a Sagittarian. Mine was December 7th, 64.
oh, no kidding. Whoa, that's
Mine
a
Yeah.
was
rough day. That's a
mine
rough
was
day.
the 12th. So
Eric,
Wild.
when's yours?
the 12th, it passed. It was
That's
last Friday.
wild.
Yeah.
Crazy.
Yeah. I'm coming
Yeah,
up
that's
December
crazy.
31st.
Happy
Oh my
birthday,
God, Happy New
everybody.
Year.
Happy birthday, all of us.
Yeah,
Yeah,
Okay.
Happy
exactly.
birthday.
Catch you guys later. Take
Happy
care.
birthday,
Excellent. Thank you all.
December.
Thanks for hanging
Thank you,
out.
everybody. And happy
Bye-bye.
birthday or belated birthday. Bye, everybody.
All right. Bye-bye.